Greetings, greetings, greetings. You are now tuned into the Vault. Trust Christian Own, nothing control everything. Just want to thank you for tuning in live or listening to replay. Always appreciate our live listeners or people that listen on the replay. It's always appreciated. So just want to thank you all for listening in. Everywhere you listen in from around the world, we have a ton of people that listen in from around the world, and I always appreciate the inquiries from wherever you are in the world. So appreciate you all. But once again, thanks for tuning in to episode 171, No Competition, Active versus Passive Investor. This is going to be a great episode to have a conversation in a market where some of the top billionaires and wealthy people in the world are saying that they would say to the common man or people in general, they say this publicly, or a few of them have said it, that they would tell people to take more of a passive. Right. So they said that the fund is actually made up of 13,000 funds, and they have investment people that oversee this in a single entity. Uh, they say the fund could be used to eliminate school tuitions, but they're not going to do that because it's controlled through private interests. And we're just going to move on. They definitely uh, they take high risk. They give great returns. Over thing it is pretty good. You guys can Google this article just about Harvard's endowment fund, and that is worth over 40 billion. You'll kind of see that they have actually the largest, one of the largest in the country, which is really interesting. Uh, you all can look up another article. Oh, this one's taking a couple seconds to pull up. Okay. Millennials will become the richest generation in American history as baby boomers transfer over their wealth. Just a great article you all can look up talking about millennials because they are going to be getting their baby boomer money, whatever is left over, whatever they supposedly collect and have or have and don't collect via uh, Social Security and passing it along in that manner. So very important situation here to see how the wealth is actually going to be administered from one generation to the next here, whether it's going to be will or trust or whatever it is. They say digital tax is a poor fix for corporate avoidance. You see a lot of companies now utilizing digital assets because there's a different type of taxation online in multi jurisdictions as opposed to one particular jurisdiction, whether you're in one particular state or in different jurisdictions. So it's very important to know that digital situation incurs a different type of liability, when it comes to just different jurisdictions and things of that nature. So, interesting aspect to look into there. Uh, they have another article out. It says Harvard's endowment is doubling down in private equity. So as you can see, the narrative right now throughout the year has been, they've made a couple moves here at the end of the year that have been significant, or a move throughout the year that's been significant. And you all can just see the space that they're operating in, the way that they're moving in the market and things of that nature, which is interesting in and of itself. Uh, let's see. I think we got some more articles. Had actually quite a bit of news come through this, but. Yeah, so definitely we're gonna move on and go forward with this episode, which is 171, episode 171, no competition, active versus passive investor. Really wanted to have a conversation about the non-politically correct conversation of no competition. Um, you know, Went to a private wealth event recently and, was sitting in a room with some asset managers, brokers, and, across the board, a lot of the brokers consensually said one of the most challenging thing in their business is that they are looking to service better because the competition is so stiff. They used that word specifically. They said competition was very stiff, because when you look at it from a consumer standpoint, the consumers don't know who's a good advisor from a bad advisor, who's a good broker from a bad broker. A lot of people don't have the access to weed through them, don't have a lot of interview conversations or questions to ask from the public side. So when you see the no competition, there is competition. Not just from the consumer investor side, or would it be active investor side, or even what would be considered passive. Uh, a lot of times when we look at no competition, there seems to be a consensual there is no competition in the financial markets, or there is no competition in people growing their estate or their wealth, but there is. And we can see that even in the service industries that they're developing for people that are looking to grow wealth from one generation to the next. There is fierce competition, whether they're coming from the bigger banks, the Morgans or the Saks. They're coming from major institutions. We see HSBC. We also saw who else in the house? Uh, we saw definitely JP was definitely there. Um, so when we talk about competition, I mean the major banks are looking for active investors to use their bank as a bank. The competition's stiff. There's been a consolidation in the banking industry, so you could say that there's been cutting down of competition because the bigger ones are buying out smaller ones. So that eliminates competition from smaller ones to grow to be bigger ones. There is a competition. See, people would say there is no competition, but there is a competition. There is a competition between institutions wanting to, once again, to hold the funds to for the investors, and then they're holding funds for the passive investors, the ones that do the CDs, the one that do the money markets, the ones that do the savings accounts, the ones that do IRAs, the ones that do 401ks. Those are passive. The capital is sitting there. Active is an active portfolio management system that's in place, and there is competition in the active side. There might be no competition in passive. Why? Because the capital's sitting, whereas in the active side, it's very much so. Its competition is stiff, competition is fierce. Uh, we see it in the market. It's a zero sum game. That's the difference in the active markets. It's very much so zero sum. What put up can be taken away. Whereas in the passive side, passive is almost wanting to not give these guarantees, but they're giving some type of minimal rate of guarantee. So they have to put a of in front of it because it's not a guarantee, but it's an of it. It could be or it could not be, but somehow we got it to be because it's called manipulation. But we're going to stick on tonight no competition, active versus passive investor, because there's some distinctions we want to make for our trustees to say, hey, look, trusteeship is an active investor role. Trusteeship is not a passive investor role. You traditionally there wouldn't even be considered a passive investor in the marketplace today. The passive investor, they shouldn't even be called an investor. But the reason why they're called investors on the passive side, particularly we're not talking about passive income or active income investor. We're talking about as a investor, there's a passive approach and then there's an active approach. The active approach is portfolio management. It may have passive real estate property, it may have passive stocks, it may have debt, it may have whatever asset, but those are diverse assets. They are under your management. You're active in the management, whether it's of people or the actual assets itself. Whereas in the passive investor side, it says we're going to go into what's considered to be these safe so-called investments that we see in the marketplace that people recommend in the marketplace. See, here at the Vault, we don't have legal advice. We don't have financial advice. There's no need to have those conversations. We are able to have open conversation about the marketplace. There is competition in the marketplace, and because there's competition in the marketplace, if we heard an investor earlier say this, there is no more land being created. By there not being more land being created, an active portfolio management system has to be in place. a passive approach is almost looking to accept second tier investments. That's why when you see companies that go public, competition once again, they're going public now, they have different tiers of stock. They have A, Class B, Class C stock. We can go even further when you see common shares versus preferred shares. When you see founder stock, when we see these things in the public, companies that want to say, "Oh, I'm a founder." People want to say they're a founder, but do you have founder stock in the company? That means you actively took a role in building the company and you're not passively taking funds out of the company as, oh, well, the company's made it $1 million. We're passively taking money out of the account. No, active actually has the company doing everything still. You're still in the founder position. You're still holding the founder stock. You're not selling founder stock. Active approach means you're growing the founder stock. Passive approach says, hey, we're going to sell some of the stock, possibly even put some of the stock in a smaller investment. So it's so many ways to talk about the passive and how the passive can go now to the bank and sit on capital as opposed to the active investor side with the company. The active investor is actually using the money for R&D, for research and development. That's an active going back in, doing what the traditional companies do on the public side, such as Apple or Amazon, when they do corporate buybacks. When they do corporate buybacks, that is competition. They're not allowing their competition to out research them. They're not allowing their competition to out research and develop them with the development of their product, development of their service. So it's the same exact thing as an investor, overall general cliche investor. There's an active approach that literally states that there is an everyday working hand in hand with maybe possibly other people's money or other people. There is a competition. Why? Because there's a lack of talent, and since there's a lack of talent, you have to sift through the bad talent to get to the good talent. The good talent that's going to enable your active investing approach to work without you almost at times. So we are in the space of active investment. So we see teams that are being deployed. When you see an active approach, there's 3 to 4 financial advisors or asset managers managing a portfolio in teams, and we see that whether it's in two, whether it's in four, we can see bigger teams, but we see teams approaching it. So it's still an active approach. It's a team approach. So it gets even more competitive because there's a competition within the team. It's not a passive approach of not showing up. Um, Passive. There is competition in the marketplace right now. The competition is fierce. Um, we see capital going to bigger companies because these guys are looking to be very competitive in the marketplace. When you see major companies competing against each other, they've had people buy into a vision that states that we are going to make the best, most addictive product on the planet. And whether people want to believe it or not, Apple cell phones can be considered that. Cell phones can be considered an addictive product. And the competition is fierce to get your phone created to even have a standing chance of being able to compete with Apple or a Google. But there is room for growth. See, people would like to say there is no competition, but there are people that are in other markets, smaller markets, markets that these companies are not in, that are able to build different active investments that people are still investing in. Who they have companies, a lot of companies from around the world that are building phones, that are building search platforms. The competition is there. So when people say there is no competition, no, there's competition on the active side. There may be no competition from the passive side because what is the need for competition on the passive side? The passive side doesn't encourage competitive growth and development. It only asks for minimums. It asks for what they say return on investment, small investment returns. Whereas we say active, active may be more risque, active may be just simply put more active. It involves more of a hand to hand inside of the actual investment portfolio itself. And so that's what we really wanted to share with the listeners that listen to the vault, is that sometimes it does come across that there is no competition in the marketplace. You can move. Some people can move rather slow or lethargically when it comes to them maintaining and growing family wealth. But if you're listening to the vault and you're looking to grow family wealth, there is a competitive mindset even in a family wealth environment, whether you're dealing with it every day or whether you're not. It's very competitive in this space. Why? Because we're dealing with it from both approaches. We're dealing with it from the broker dealers, dealing with these brokers bringing deals, and then we're dealing with the banks that either are giving the family capital or holding the family capital, people that are actually possibly managing family capital. So you, even as a trustee of the family estate, being able to deal with the everyday portfolio managers of possibly a huge sum of money from the family, at the end of the day, it's still competitive because there are people that are trying to compete to hold the family's capital. And so we should be aware of those relationships, be exploring those relationships. A lot of people ask, well, where are the active investor relationships as opposed to the passive investor relationships? Why? Because you think about it, the average person is just trying to put their money in a 401k, they're trying to put it in some type of IRA, and they're trying to let it sit. The active investor, they're going out there. They're possibly gotten burned a few times. Failure is not, it's not that it's not an option. Failure just shouldn't be continuously repeated, specifically with the same style of mistakes. And active investing forces us to learn. The competitive market forces us to learn, as whether it's trustees, whether it's entrepreneurs. Some people think, oh, there is no competition in my public sector. I don't see anyone around me. That's because you're not going to the trade events or you're not going to the industry events where you can see that they'll tell you in the room, it's competitive. They're all in there. It's competitive. Not maybe sometimes internally, but it is internally, because particularly when we look at it from 30,000 view, we can see families being very competitive over land. And then we get into the passive investor looking to sit on, their life savings. Whereas the active investor, there possibly is no life savings. Life savings is gold and silver. Life savings is collectible art. Life savings is property that's it's actually fully acquired and protected. Life savings. Savings is something maybe we could say we pass actually on to the next generation. If we're going to say savings, what did we pass on to the next generation? Because what are we saving right now that we need to be using to grow? It's a growth mindset. It's an active mindset. It's not a passive savings. Passive is supposed to grow. Traditionally, savings doesn't grow, but it does when we look at hard, tangible, appreciating assets. But that's not liquid. So when we even say active, once again, we sat in a family room once again this past week. We've heard this before, but hearing it in a room more and more, still consistently, still to this day, years down the road, when you hear the same style conversation coming out of wealthier families saying, hey, the market is competitive. We want liquidity. When they're still saying the same type of terms, we want liquidity. We want liquidity. It makes you say, even as a trustee, how liquid are you? How nimble are you in your business venture? When we say, oh, there is no competition, there are, whether people know it or not. Every founder, this is something that we had to sit in a room with the founders, and everybody wants to be a founder on the tech side. But what happened to the exit strategy? Every great tech founder has an exit strategy. I mean, whether people want to believe it or not, they have an exit strategy. It's in the plan. If it's not in the plan, you see what companies fail. Every great one. When you all look at most major tech companies, the founder has taken less and less of a role after the launch of the company. Especially the tech round right now. I mean, where these guys are raising, 10 million, $100 million plus funds, and so obviously, it's an easy cash out. It's an easy cash out. It's when you look at the banking sector. If you're a CEO and they're going to give you a $40 million bonus, why wouldn't you sit on the board? You take your 60 40, you take your 60 or you take your 40, and they're going to make 200 million. They're actually going to make 200 billion dollars. The banks. And so when we say non-competitive environment, it's very competitive. Those CEOs are getting paid to manage wealth, capital. The market is very competitive. And that's why we say, even in the active side, when they talk about liquidity, yes, that's very important. These guys are talking about, talking about the same thing we've always talked about, liquidity, of course. That means how nimble are you into cash? So they kind of all played when we were sitting in a room this past week at it was a wealth forum we got a chance to sit in. Literally, they said the markets were at all-time highs. They all said that the market's trending out, it's going to continue going up. And we're looking at them like, aren't you guys looking on going on vacation? Where do you get your money to go on vacation? A bonus. So these guys are going to take their bonus money. The way they get bonus money is by giving away money. Don't Isn't this the time of the year in certain hemispheres where people are using more debt, credit cards, than ever? Competition's fierce. Whose credit card are you going to use to be in debt next year? Who's going to get interest before you even get to the principal? Active investing versus passive. It's knowing the different environments to be in to where your family, you benefit, or at least are in control of whatever is there, liability is there. But we just wanted to share this message. It was something that we felt was really, really good to talk about. So many people that think that the markets aren't competitive, the people that they're around are not competitive because they're in the same industry. But when we talk about our audience goes from 50K to 5 million plus. We get that wide of a range, and so when we get that wide of a range, we know the people that they come to us through the years. Still through the years, we hear there is a lack of competition mindset, but when we look at the active investors in trusteeship or investorship or in entrepreneurship, when we look at the active approach, we see great growth, we see great multiples, we see the diligence of the incremental growth grows to momentum, whereas and that's from an active approach, whereas the passive, there is no momentum, it's steady growth. When we even look at passive, it gives passive results. It gives results that are what we would consider mediocre. Whereas when we go into even an active environment, competition does make the process of active investing or growing in yourself or whatever is it you see the competition. And we just want to put that out there for so many of our listeners that say, oh, we listen, we're not around a lot of investors, or we're not around a lot of active investors. And so what do we say? You got to go out now and increase your level of competition. You cannot be around no competition. You have to be around competition as an active asset portfolio manager because that's how you get better. Whereas in the passive environment, there's just a giving up of capital. It's giving it away to someone else. Asset portfolio management, there's a lack of it. There's a focus on someone else managing the portfolio, and we see this across the board. So we're talking more to the active investor, or because the passive, they're not caring to grow, whereas the active investor says, "Man, there's a there's a need for me to actually get better, and the only way I'm gonna get better is by competition." We already know there's so many people that are gonna say, "Oh, I don't want to believe in competition. I compete against myself." Ladies and gentlemen, there's a championship. A championship is you achieving your goals, and that takes an active approach. Getting to the goal. That's why savings is not encouraged in the states. It's minimal interest. That's why it's minimal interest given. Active approach says we're not going to depend on interest. We're going to depend on our work. We're going to depend on the active diligence that we put into managing and diligently doing whether it's R&D or growth and development, but we're focused on doing that towards our process. And so once again, how do you get better at that? You get better at that through competition, finding people that are going to push you to say, okay, how does your process look? How are you winning or are you losing? And how can we increase your rate of winning? And those are things that help you specifically in your field. A lot of times, a lot of people say, oh, you could go get a mentor. We definitely believe in having some level of accountability and tracking, but you know, being in a competitive realm has brought out all type of what people will call demons. Why? So many people don't know how much training costs to be one of the best in what you do. The active approach. There's a lot of capital invested in training. And guess what? There's a lot of people that may or may not be investing in their training, but the education separates the active versus the passive investor. This is what we've seen as a consensual from the vault. The people that don't know anything, they don't do anything. Okay, fair. You don't know what you don't know. But when you start learning things, you have to keep going. And the ones that pull the throttle back on their education, those are the ones that lose. The ones that win are diving deeper and deeper into the education. They're very much so up to date because they're in the focused on being competitive. They don't want you to know more than they know about what they're doing. And if they do, if you do, we'll be asking you questions. Competitive environment. Never not humble to learn. Always humble to learn. Always eager to learn. Competitive to learn. Competitive to be the most knowledgeable about the active investment or asset that's being managed. Always competitive. Some people say, oh, you're still going to learn against yourself. It's just competitive against yourself. We're talking about an environment in business where numbers separate you. It's growth. When we talk about the numbers, we're talking about growth. Competition means someone's better because they have more capital. They have capital under control. Passive is sitting around saying, hey, somebody else is going to manage the $8 billion portfolio or $8 million portfolio. No competition. Hands down, they won. Someone wanted to take a passive approach. In an active environment, someone says, I'm not going to let this guy that so-called has these letters behind his name sit here and tell me everything that he's going to look up on every financial magazine that I could have subscribed to and and literally looked at some, who knows if they have insider information. Insider information almost eliminates competition. Everybody we've seen come out of the investment bank has insider information. There's no competition against somebody that's come out of an investment bank. Somebody that's come out of the investment bank traditionally is going to have they're going to have a substantial wherewithal of financial literacy and capital markets. Someone that's even coming from we sit in front of these guys. These guys, let's just say they're a securities dealer. Okay, they have a knowledge. Oh, yeah. They can leave any investment bank that they're at and go into any smaller market and eat up people and eat them alive in financial knowledge base. They can go into markets because they've seen markets from a higher level. The competition is fierce. You say, oh, well, I'm in my market. What do they know about my market? What do you mean? They're selling securities about your market. They were selling bonds against your market. The competition is fierce. If they come into your realm and they swim in a little pond or they swim in a pond that may be smaller than what they were swimming in because the pond they were swimming in, the competition was fierce. It was a lot of sharks. It was a lot of people that you're working at an investment bank. So when you're working at an investment bank, the whole purpose is to bring money back to the company. And in turn, you are an investment manager. And so in turn, the competition is fierce because the banks are not working together per se. That would definitely be a bad look for most of the public. They would be highly upset if the public knew that. So there is a competition in the investment bank industry, and there's a competition in the family office industry, family estate industry. Once again, we talked to a family trustee, quality trustee earlier today. Someone that we could just say on a trustee level for sure we have to respect because they definitely understand the importance of the education. Now, and we could do an episode about this so-called financial literacy versus financial empowerment. Financial empowerment is people actually putting the knowledge base to use. There's this big difference, and this is what this family trustee said. He said, "There's no more land being created. If there's no more land being created, the competition is fierce, for sure." We want to say this from a business perspective, not from this whole, greedy life perspective. We're talking about from a business perspective, investor perspective, perspective that, when people are in markets, the lack of competition does not promote growth. There's a lot of competition in the tech market right now. You see that across the board. That's actually one of the best things actually about the tech market right now is that there's so many companies that are entering into the marketplace with these ideas to make your life more efficient and make your life easier and make you not have to remember anything and everything goes in the cloud. These type of technologies bring they allow for passive investing. Oh, we're going to take the change off of every dollar that you spend. So if you were supposed to get change back from a dollar, we're going to put that into some small type of derivative investment. When you hear those type of advertisements and things of that nature, there's competition even for people's quarters, dimes, and nickels on investment platforms for these banks right now. They got these apps now. These are applications people want on their phone. They want to take a passive investor approach. Oh, just take the change off for every dollar that I spend. So if I have to pay $1.25, 75 cents would have been $2. We're going to round up because now they got these programs that are round up, and then they're going to just take out the 75 cents. Okay. They're going to help you invest passively because you're utilizing these apps and making payments through these apps for products and services and things of that nature. See, there's an active approach towards getting people's money right now, as you can see, even on the technology platform space, with people looking to help people become more investors because they're seeing that there's a fall off in investorship because there's a lack of knowledge base. But instead of giving education, they're just going to go ahead and take the money off the top. That's how it goes in with these new apps that we've seen out here that are going to just take the money off the top. Interesting to say the least for the passive investor. So what does that mean? You spend more money and you get more money off the top to invest more? How does that work? You got to spend more money now. Interesting. Instead of just taking an approach of growth, the approach of teamwork, the growth, the mindset of expansion. And for all the ones that are trustees that say, oh, we don't know what the competition is out here, ladies and gentlemen, as you're a trustee, the competition is fierce. You already know in the private, you don't own it, but you control it. There are people that control plots of land forever. When we talk about Harvard, you think Harvard is going out of business? The assets that they own, they're not going anywhere. The assets that they own, see, they're in the $1 billion category. They're not going anywhere. I mean, granted, you could see a $1 billion fund possibly disappear at one point in time in history. We can see a $1 billion fund disappear, but this is the college. They're not going anywhere. We understand the IP that they're producing out of this particular school. Their fund's not going anywhere. Their asset holding's not going anywhere. Solid passive approach. We can see they've been around for 100 years. They stake out more than 100 years. We say to the family and the successorship, hey, you go where longevity is. Active approach. Competition is fierce now to put up a company that can stand 100 years around. They have a 100-year-old fund. It's important to put up a company that can stand 100 years now, 50 years now. Why? Because these are institutions that are saying, hey, look, whether you know it or not, around the world, we're gonna hold assets, whether your family wants to participate or not. Now, if you guys want to get in with us, we're gonna continue growing past 100 years, but we're gonna allow you to place assets as well. Competition is fierce to produce that mindset across the world. Oh, we're going to go to the bank and get 4%. What is Harvard giving? And they're giving that for over 100 years. Some of the banks most people are dealing with now, those banks haven't even been around 100 years. They've been bought out, they've been sold, they've been ripped to shreds. Public banks have been ripped to shreds in the public markets.
Competition's fierce on the public side. Who can keep their name good? Who's doing commercials to say, "Oh, we're doing good after 100 years of somebody doing a hack on us? We got to clean it up real quick." Or someone putting up, these smears that we're creating phony accounts or whatever it is. Competition is fierce to have integrity right now. It's fierce to have integrity in the marketplace. It's so easy to go and take the passive approach and say, "Oh, we're going to put out a defective product. Hey, who's not putting out a defective product? We got an insurance fund to cover the defective product." Competition is fierce to have integrity right now. There is a competition because not everybody has it. And the ones that do, they're competing off of their integrity, standing better than others. There's a marketplace. That's why they call it a market cap. We appreciate the competitiveness. For everyone that is competitive, we love you all that are inside of the business realm or any realm. It promotes strength and growth. So we appreciate you all. Thank you all for listening live to the episode. Christian at trustchristian.com. Appreciate you all. Look forward to hearing from you.